Hey everyone, so another serial acquirer out of Sweden today. I'm looking at Instalco as the title suggested. So we're going to jump into that. It's going to be quite a long video. I might even split it up into two parts. And if you want access to this company, you're going to need a broker that can give you access to international markets. And I know that Interactive Brokers definitely allows you to do this. There's a link in the description below. It's the broker that I use. I think it's the safest broker out there. And if you want to take a demo account for a spin, you can do that by going through that link. And I've got videos here on my channel that show it in detail on exactly how to use the platform. I think it's pretty intuitive, and it's definitely the one you're going to need to access companies just like Instalco. All right, let's jump into this company. So Instalco essentially is a roll-up strategy of small trade businesses in heating, ventilation, and air conditioning. That's abbreviated to HVAC services, HVAC. Acquisitions is the core part of this strategy for Instalco. A brief history on the company is that it was founded just in 2014, so it doesn't have a long track record here, by a guy called Pt1. I'm butchering that name, I know. He owns 10% of the company. He initially acquired 5 of larger companies and formed this group. 3 out of the 5 of those acquisitions were in heating and plumbing. The other 2 were in electrical installations and ventilation. And since 2014, Instalco has been able to acquire over 120 different businesses all around the Scandinavian countries. Okay, so the company says that they have 6 of these, verticals. We've got heating and plumbing, electricity, ventilation, cooling, industrial, technical consulting. And under each one of those, there's actually 10 to 20 specializations that you can be inside of that. So imagine electricity, you can do obviously, electricity for the home, but then you've got power lines, and then you've got warehouses, and you've got power plants, and there's a lot to do with just electricity. There's so many different types of electrical contractors you can hire and specialties in that space. And that's the same with all of the verticals. So there's a lot going on here, and there's a lot of different kind of niches inside of these verticals. Where they're operating, you've got here, you can see most of it's in Sweden. 76% of sales is coming out of Sweden, and then the rest of the Nordic countries. It says here, over 125 companies now. And the customers are primarily construction companies, property owners working with commercial facilities, office premises, residential property. Some of the major customers are essentially government authorities, schools, nursing homes, hospitals. Then you've got major retailers and refrigeration companies and councils. So yeah, there's a lot going on here. There's a lot of different customers. There's a lot of different size of customers as well. And there's a lot of different geographical areas that they're covering as well throughout the Scandinavian countries, as you can see on that map. So what I want to look at here is why organic growth is really important. See, what happens without organic growth is that the mergers and acquisitions will be the only way that they can grow. And if valuations go up in acquisitions, well, the growth is going to get more expensive. Therefore, the return on invested capital is going to get worse. And as an investment, this sort of sputters along. Organic growth is where that return on invested capital can actually improve, even if multiples for acquisitions stay the same or start to increase. You need sort of 2 engines running here. You need to buy companies at low multiples, as low as possible, that are good, reliable businesses. And I'm going to argue why these are maybe not the most reliable businesses going around. But you also need that organic growth to come out of the businesses as well. Otherwise, 1, you're going to struggle to keep up with inflation. And 2, you need to essentially alleviate for any busted acquisitions. So as you can see, from 2021 to 2022, you've got 2, I think, it says in millions. So it's 2 billion SEK in acquisitions and about 700 million in organic growth. So about a quarter of the growth is coming from organic means, and then 3/4 in acquisitions. And I think that's actually pretty reasonable. I actually think that's a lot of growth. As you can see, you've gone from 8.8 billion to 12 billion. That's quite significant growth. What's that? 35% in sales, but getting a chunk of that in organic growth, a quarter of that increase, I think is good. You need to see that. I think single-digit organic growth is fantastic. There's a lot of stability with that. That's keeping up with inflation. If it's high single digits, if you're getting double-digit organic growth, that's exceptional, but that's pretty hard to do. So I think this is a pretty good balance. Well, that's just 1 year, so we'll look at 5-year data a little bit later. But I think the other thing I wanted to highlight here was that the order backlog has actually risen 23%. So even though I'm a bit nervous about the quality of the revenue, the quality of the sales being essentially trade businesses that are going to really be impacted by macro factors. The fact that their order backlog has improved and is quite large, like that's, 8 billion SEK. So that's 2/3 of the sales of 2022 are already kind of booked in, ready to go again. So it gives a fair bit of foresight into what's coming in 2023. So we've already got a base there that's pretty strong. I would say that's a good sign of we're not going to get wiped out in the short term on this investment. I wouldn't think, with that order backlog being so strong. We're going to have a look a little later of why the share price has come down quite a lot, and it's probably because of this. The earnings per share has come back a little bit, and we'll go into why that's the case a little later. Now, this image on the screen here I think is really cool, and this is courtesy of the Serial Acquirers Primer. Please look up, I think it's acquirers.com is the website. They have an ebook in there, and I've pulled this from the ebook. I hope they don't mind. But this is a fantastic picture, and I'm going to give them full credit for that. So Serial Acquirers Primer is the name of the book. Please read it if you want to know anything more about serial acquirers. It's epic. So what we're looking at here, this is a little bit old, but it's essentially showing us that what the return on invested capital and organic growth can look like for the different businesses. And what this trend line is suggesting is that as businesses sort of get bigger, those circles become bigger, they can't really maintain a high return on invested capital plus organic growth. And if we look for where Instalco is, they're right at the top here at getting around 30%. Now, this was taken at least a year ago, because I'll tell you now that return on invested capital is down about 20% now. So it has come back a lot. And on the x-axis here, you can also see this is the 5-year cumulative acquisition spend. So how much USD they've spent. This is 2 billion, 20 billion, how much they've spent. As you get bigger, that number seems to come down. The return on invested capital net come down. The outlier here being Constellation Software. They're a lot bigger now. That circle would be probably twice as big now, and it's still getting those huge return on invested capitals. They're the standout performer here. So let me show you another case of that. So if we look at just deal size now, so now we're looking at how many essentially acquisitions per year they can make. Instalco did about 16 last year, and I think they did about 16 the year before. So that puts them here. Higher the better in this case. And some companies, the idea is that it's really difficult to scale deal volume. Like once you get up to that sort of 15, 20 deals per year, it becomes really difficult to scale the deal flow, because essentially head office can only handle so many acquisitions a year. There's just, even if they get on more people to do it, everything needs to be checked, and everything needs to be like the gut test needs to be made. Everyone needs to have interviews. There's transitions in place. It's hard to get that deal volume much higher than 15 to 20. Again, the exception here is Constellation Software, who have gone way over 100 in the past 12 months. They're up at 80 at the moment. Unbelievable how Constellation Software have been able to scale their deal flow and decentralize acquisitions. Unbelievable. They're the freak in the room here. So Instalco here is still well above average. And regarding decentralization, Instalco with Pierre and now Robin, who's the new CEO, both strongly advocate for this highly decentralized operation. And that's the playbook of all the good serial acquirers. The reason is because you need local businesses to run themselves, because they're closer to the customer. They can be more agile, they can adjust, they don't have to follow set rules, they can do things on the fly a little bit, as long as they understand like the main key metrics that need to be looked after in the company. For example, as long as they're good with their costs, their spending, they also know that they can pass on like price increases as needed, and things like profit metrics or return on invested capital metrics or things of that nature that head office would be very interested in. As long as they're all on the same team, it should be fine. But essentially, you've got to allow the little companies to do it themselves and trust them to do it. And that's how you can not micromanage, and you can then continue building this big business and get to 120 plus acquisitions. So I really like on this slide here in the annual report how Instalco have identified like their important goals of their business. And I think they're the right goals. I think they're the right things to be tracking. So firstly, we want to see growth, of course. And they're targeting just to make sure they're growing at over 10%, and they've been killing that for the last 5 years here. They're well over 20% each year, 35% in the last 12 months. But the next metric, more importantly, I think, is margin, and they want to keep this greater than 8%. 8% is actually relatively low for a business, but that's their goal. They are in a trade services kind of industry here, so I guess 8% is fine. It should be able to create long-term value if they can keep their margins above 8%. And it's just slipped below 8% for the last 12 months. This is margin of EBITDA margin, by the way. And look, we can go through... in the annual report, they go over this quite a lot, but essentially there's just a lot of macro things that have been going on in 2022. We've got the war, we've got price inflation, we've got supply chain issues, lots of kind of problems going on where margins it's been difficult to pass all the prices on to customers quickly. It is coming through, there's a bit of a lag between you get charged this and then what you can charge at the other end. So it kind of makes sense that margins are a little bit down. This is not just Instalco's issue. This is very much across the board in Scandinavian countries that I've noticed, especially in serial acquirers, is margins have come back a little bit. I would say that they've passed that on to customers now, and you would imagine margins will be back up to normal next year. Next is debt, and I think this is really important that they are monitoring this, but I think this 2.5 times it needs to be less than 2.5 times. I think that's too high. I think it should be less than 2 times. But anyway, they're running at 2.1 times right now. I think that's a little bit high personally, but I guess they've got a good order book and they believe their revenues are solid. And yeah, with a strong order book coming through, they've got some foresight. They can probably do something like this, have a little bit more leverage, but I would be more comfortable if it was closer to 1 rather than in the 2s. That's just me personally. I'm just a bit nervous about debt. Cash conversion rate, I think this is really awesome. I think it's great that they're showing that essentially how are they able to turn the earnings that they're getting and keeping that in cash. And at the moment, it's 85%, and like that's a little lower than what they were looking for. They're trying to get it 100% coming through down to operating cash. And I think that's a really good goal. That's really good for us to see as investors. It'll be easy for us to value the company essentially, which is great. Last is the dividend policy. They're trying to make it 30%. I'll talk about what I think of the dividend policy a little bit later. And yeah, anyway, there you go. That's something that they're trying to keep stable for their investors. Okay, now I'm not a big ESG fan. I think businesses kind of naturally have to be good at ESG. Instalco are measuring something that I like to see though, which is essentially their happiness, health, and safety. And I know that's a bit soft and a bit airy-fairy, but I actually think employee satisfaction and them actually measuring this is really important. And they're trying to have employees being satisfied with their work situation overall. They want it to be greater than 90%. It's at 85%. So I'm glad that they're monitoring this. This is going to be critical for their business if their employees are happy or not. I think that's one of the biggest factors you can have in a successful business. And 85% is strong, but I'm glad they're trying to get it above 90%. Employee turnover to be less than 10%. It's at 14%. Nearly 15%, and that's a bit higher than I would like to see as well. So I'm glad they're monitoring these things. And absence due to illness is they want it less than 5%. It's about 5%. I just think that a lot of companies should be figuring out ways to track these numbers, because this is the internal health of your business. And I don't know, a lot of companies don't measure this stuff, and I always ask them, I think you need to measure this stuff. Like, this is how your business breaks, is if the people who are working for you are unhappy with high turnover and lots of sick days. That's costs. That's going to cost you money to fix those problems. And I don't know. I just think it's the right way to run a business, and you've got to keep everybody internally really happy and motivated, driving this thing forward. Otherwise, like, head office can't do it. It's got to be done from the ground level. So I think we all agree with that. We've all worked for companies before, and if you're happy, you're doing a better job, and everything works better in the business if everyone's happy. So, important metrics here. Glad they're tracking it. Now, I like to see recurring revenues, and for this business, it's not that strong. The majority of the business is project or tender work. This makes things rocky when times are going to get tough. Being diversified among so many different businesses in a handful of services does help mitigate the impacts of like downturns, but revenue quality, I believe, isn't strong. I think they said its recurring revenue is around about 20, maybe 25% of all the revenue. And I've seen businesses where recurring revenue is 70% plus. So I think the quality is not as good as like CSAM Health is the company that I'm referring to, by the way, that have 70% plus recurring revenue. Dropbox, I think, is really high as well. So, but I do have to add that that order backlog was really good, and that's a good sign for the short term, and that's an important metric that we should be following each year on this investment. The next thing that's interesting about Instalco that I think is a competitive advantage is that their scale is going to help them get more work. See, they can bring in multiple of their smaller business segments together to complete like a larger project, something that a smaller team of say 5 or 6 guys, they wouldn't be able to do this. They wouldn't be able to bid on a bigger project because they wouldn't have the expertise, but sharing and the scale of Instalco is actually quite a big business advantage. So you can pull teams together essentially to get bigger projects and longer work. Now, regarding what they're paying for their acquisitions, Instalco say that they've been paying on average around about a 4.2 times EBITDA multiple, and that's without taking any of their synergies into account. After synergies, the returns do improve, and that does explain why the return on invested capital has been well above 20% for quite a long period of time now. Now, making these acquisitions isn't always as smooth as the math suggests. Just because you're paying 4.2 times EBITDA doesn't mean you're going to get your money back in 4.2 years. See, many times the acquisitions will pay back faster or generally slower, depending on how good the operations are. Like, just think about all the things that could go wrong here. So you've got like macro factors. So there's a war, there's inflation rising, you've got raising interest rates, you've got COVID, then like people factors, like someone, maybe a key person in that small business getting really sick, or they're leaving, or I don't know, something happening inside for the people. But then you've got all the benefits of being at scale, like winning that large ongoing customer. So I think it's going to be all over the place. And I would imagine that more often than not, things aren't paid back anywhere near the acquisition multiple. Robin, the CEO, actually has mentioned before in an earnings call somewhere, I found it in a transcript, that before a little business is getting ready for sale, they they call it dressing up the bride, essentially. So they're making the business look better than it maybe historically has been. So it looks like there's a bit of growth coming out of the business, and you're like, oh, maybe we can get a little bit more for it. Robin's very aware of it. They've done over 120 acquisitions now. They're very dialed into what's going on in that situation. So you can imagine paying 4.2 times might be, they're really paying closer to 5 or 5.5 times on average, something like that. And then maybe with some synergies, but then maybe with some people leaving, there's a lot of fluctuation going on in what they're getting here. So making one acquisition is pretty volatile and very risky, but I think that's why you need to see a track record over lots of different acquisitions, lots of small acquisitions, hopefully over quite a long period of time, over maybe a few cycles even, to really get a good understanding of how good the business actually is. Okay, so I've covered a lot today already. We're going to dive further into the numbers in the next episode, so stay tuned for that. I'll put that out tomorrow, and we'll hopefully get to quite a strong negative point of view on this business, and then I'll also do a few valuations as well, and we'll go through what I think this is worth and maybe what a good price to pay for this would be. So stay tuned for that. I hope you're enjoying a deep dive into Instalco. I know I'm missing a lot here. I've got a lot more work to do on this, but I hope this is helping your research if you're digging into this one. All right, I'll see you in the next video.